Plan for profits and then work your plan. That phrase best describes the value of cash flow budgeting. The planning function of management is one of the most important for the farm manager, and completing a cash flow budget is an excellent tool for doing so. The cash flow budget is a plan of how cash will be coming into the operation and leaving the operation. The key word is cash. If cash is not entering or leaving one's pocket, then it does not go on the cash flow budget. The cash flow budget provides three primary values for the farm manager. 1, it forces the planning function of management. 2, provides a means of communicating the amount and timing of borrowing and investment needed with the lender. And 3, during times of low profitability, cash flow is a survival strategy. Completing the cash flow budget requires that the manager plan ahead, know and or estimate what they will raise, the inputs needed, the input costs, output prices, capital asset replacement, sales of purchases, and other factors that could either provide or take cash from the business. So what makes up a cash flow budget? A cash flow budget consists of cash coming in or leaving the business. Cash inflow from operations can include capital asset sales, non-farm sources of income, which could be included if used to pay the farm bills. Some cash outflow from operations are capital asset purchases, non-farm outflows of cash including family living, and debt service. An influx could be new borrowing. And so all of that together equals the net cash flow. Net cash flow must be positive or at least zero, which is the break even. While it can be negative on a spreadsheet, in real life it must be at least zero, even if that means bills and debt service are not getting paid. The cash flow budget is not the same as an income statement, especially an accrual income statement, and in fact they can be quite different. The cash flow budget does not include non-cash items like depreciation, inventory changes, and changes in accounts receivable and payable. However, the cash flow budget does include principal payments, cash payments for capital assets, and new loan proceeds that the income statement does not include. A farm manager can cash flow very nicely for a while by just selling a few cows, pieces of machinery, acres of land, or just allowing accounts payable to continue to build. The accrual income statement will quickly identify this situation as unprofitable, but the cash flow budget will see a positive. Positive cash flow does not mean profitability or vice versa. The cash flow budget is not a substitute for the enterprise budget. The enterprise budget includes depreciation and opportunity costs, both of which are non-cash items not found on the cash flow budget.